Hey, it's Ryan from the Option Income Advisor, and today I'm going to talk to you about rolling a position. And so we've got a position in Palantir that we are deciding to roll. And so Palantir actually reports earnings this coming Thursday. And we currently are in the August option. We sold an August put option. And because it's only a few weeks out, and we've actually the stock's kind of maintained its level. It's actually gone up a little bit since we got into the stock. And I encourage you to go look at the or review the other video and other article. It goes into detail about why we got into the stock. So I'm not going to go detailed into the stock itself today. We're just going to talk about the roll position. So I encourage you to go take a look at that. That was a few weeks ago. We put on the August option. And so when we roll a position, it's because we want to maintain the exposure to the stock. And what we're trying to do is really get more premium out of it, right? So we're kind of rolling our position out typically into the next month so that we can then get additional premium. So what happened in this case, again, the stock has gone up a little bit from when we put the position on, and so the option has decayed. So we've gotten about 80%. We've accrued about 80% of our position already, and so that's what's kind of prompting making this move. So I like to do it on stocks like this that are reporting earnings if I can maintain the margin of safety that we originally had and get a higher premium. So that's the case here. So we're going to look at a analysis here. We're going to roll. So we're going to buy back our August option, and we're going to roll into the September option. But we're going to maintain the same strike price, which is kind of ideal, right? So we're going to be getting more premium just by going out further. But we're maintaining our same kind of economic position and margin of safety going into earnings. So I think this is it's a good way to, again, just keep that capital moving. And as I'll show you, because the most we can get now for our current position is basically what's left on the option. It happens to be about 8 cents, right? So the most we can potentially get for that August option, even if the stock goes significantly higher, is that 8 cents. So what I'm trying to do is get a position where we can maybe get a lot more premium over the course of the next few weeks if the stock does well or just kind of stays where it's at. Because after earnings, the volatility is going to collapse and we'll probably accrue more of that premium. So let's get into the profile, and I will kind of show you what I'm talking about. So again, this stock, and again, I'm not going to go through the fundamentals of the business per se. I will say it is a very high growth, but also very highly valued stock right now. This is a stock that we've got 100 times multiple on it right now. And so that seems crazy, but this is definitely a stock that I have a positive long-term view on. And so, I do feel like this stock has a lot of upside potential, but I know it's going to be volatile. And I'll show you the chart in a minute. It was very volatile last time it reported earnings, and I expect the same, this time as well. But I think the long-term trajectory of this stock, which is important when you're writing puts, that you've got a long-term, perspective on it. I do think this company will certainly probably grow into its multiple. So this is a company that has pretty much come out and said that we are hoping to achieve 30% revenue growth for the next 5 years. So basically through 2025, they're expecting 30% growth every single year, at least, and they've been hitting it thus far. And so it's also a company that the CEO is a little bit quirky. He's actually the guy that's on the cover of this, the thumbnail of this video. But he basically came out a few quarters ago and said, look, we want long-term investors we don't manage our stock for the quarterly earnings, right? We manage it for this long-term perspective that we're giving you. And so if you're a short-term investor, we don't even want you in the stock. And that's kind of their perspective on it. So I do believe in the stock long-term. It is highly valued right now. But I mean, you can see just the kind of earnings growth not earnings growth yet. It actually did report its first positive quarter last quarter. But you can see this revenue growth has been pretty amazing. And, if they can hit their 30% and kind of maintain their earnings going forward, if they maintain the positive earnings and, continue to grow 30%, they're going to grow earnings 30% and or more. And they'll probably certainly grow into that multiple. So that's kind of the long-term perspective. But let's take a look at the put analysis. So this is the put that we currently have. Is this one right here. So you can see as of the close on Friday, you see the bid ask was 8 or 9 cents, right? So we sold this put option for 36 cents. This is our base. So this would also apply to the aggressive or conservative one if you went that route. But I'm just going to talk about the base today. So this was the option we sold. Again, we sold it at 36 cents. So now we're going to be able to buy it back, probably around 8 cents, right? And so this is what I was talking about earlier. The most we can get going forward for the next, couple weeks is 8 cents, right? That's the most we can get. So that risk reward doesn't, it's not great, obviously going into earnings. I mean, it is a 7 delta option at this point, right? So the probability of it hitting, 18 right now is pretty low. And so that's what kind of makes me say, okay, well, I like that level, and we'll get into the chart in a second, but I like that level a lot. And so here's the position that, I'd like to have on. I would just like to get more premium for it. So, let's buy this back at 8 cents, and then we'll roll it out to the September option. And so the September option will be this 917 option right here. So you can see now we can sell this option for about 30 cents. So we'll buy that one back at 8. We'll sell this one for 30. So we're kind of basically what we're doing is we're rolling our. Remember we were able to maintain about a 1.5 I think % average monthly yield for that other option, and I think we got just the 26 cents that we've accrued was about 1.4% over 3 weeks. And so we already accrued that 1.4% over 3 weeks. So now what we're doing is, we're going to roll to where we can get 1.2% on an average monthly yield for the next 42 days. So we're kind of maintaining that nice premium we've got. We're maintaining our level, right? So we still have that level that we like, the $18 level. And again, I'm going to pull up the chart and kind of show you why I like that level. And we're maintaining a nice big margin of safety, right? It's the 17.5% margin of safety. And look, we basically we're trading an 8 delta or 7 delta option for a 13 delta option, which again, it's from that perspective, I don't think that's a big change. I mean, they're still both under 15, so I think they're very, it's a very high probability trade that it should finish out of the money, right? So why not take this trade? Roll it out there, get the additional premium, and again, keep that capital flowing. That's what this is all about. This whole strategy is about making sure you're trying to generate as much income as possible off of the capital you're using. Well, we're still using the same exact capital for this option as we did for the August option, but we're only going to be able to make 8 cents, going forward on that for the next 14 days. So now we can roll this out and maintain and get a higher premium for ourselves and get a better utilization of capital. So that's the trade. So buy back the August. We're going to sell the September. So let me show you the chart again, just to kind of remind you of kind of why we like these levels. So here's the chart. And so this is what happened last time. And so just kind of walking through this chart, this is a company that just went public in September of last year. It went public at $10 a share, okay? And it just like every other tech stock did at the end of last year, right? It just shot through the moon. So this thing went from $10 a share up to almost $40 a share, $35 a share. Or actually about $39 a share. And then the tech scare kind of happened, which was basically interest rates going up. And so all these stocks that had high multiples like Palantir, well, they got crushed, right? So this stock got crushed along with everything else. And it was down roughly about 50%. And then it started trading in this range, right? So this is where we kind of got interested in it, because it started trading in this range. We're able to see what happened, last quarter. So this is when it reported back in May for Q1. So it initially sold off about 10%, which kind of created the bottom of this range we're looking at here. So it went down to about 1850 roughly. But then proceeded to go up about 50% afterwards, but then since sold off 22%. So very, very volatile stock. But again, what we're looking at is where's the good entry point, right? Where's the strike zone that we're comfortable with, and our strike zone currently is $15 to $18 on this stock. So we have a high required margin of safety, rightly so for a stock like this. But you can see it's been consolidating, just over the last few weeks, kind of in anticipation of earnings, I'm sure. And so the situation I see here, and again, that September option, remember, only has a delta of 13. So the market's really predicting that this stock probably isn't going to drop below that price either. But even if it does, I think it's a great purchase. And, I think there's a stock like this, if you can get it on a dip like that, you can hold it for a couple of months. And if it does something like it did before, you can cash in on a big capital gain, probably sell some awesome covered calls on it. And that's kind of the approach, right? But, this is a great way to accumulate shares, maybe in a stock that, you're not as comfortable, kind of playing with over the short term, but maybe you have a long-term perspective on it and you want to just be patient with, the prices that you're going to potentially purchase the stock at. So I think 18 makes a ton of sense, just kind of given, what the company has, done recently. And by the way, they actually they don't put out a ton of guidance, but they did beat their guidance last quarter. And so even though the stock did initially sell off, I think that's why it kind of ramped up quite a bit, because, it had like 49% growth. They beat their operating margins guidance and ended up being a very good quarter. And I kind of expect the same, this time as well. Again, they're kind of cryptic with things. Again, this CEO really wants you to be a long-term holder and wants you to focus on the long term, because they're big government contracts. They've gotten to the commercial side as well, but they view their business on a much longer time frame. It's not a kind of a quarterly thing for them, but I do think they are doing a good job, and again, it's a stock that I think that maintaining our patience with these levels makes a ton of sense. So I like the 18. That's the chart. Again, we're buying back the August 18 strike, and we're selling the September strike, and the whole reason we're doing it is to collect more premium. We're maintaining our risk position, and I think it's just a good use of capital. So that's the trade, and that's how we're rolling. Take care.